Hej och varmt välkomna till Global Gains. Mitt namn är Karl Lans och med mig har jag Pär
Pär
Ståhl.
Ståhl. Ja.
Ja. Och idag ska vi prata med ingen mindre än Ralf Gasser från GAM som är expert på katastrofobligationer. Det blir väl intressant, Per?
Mycket, mycket intressant. Jag var ju träffade delar av teamet för 2 år sedan och jättespännande tillgångsklass och det ska bli kul att liksom få borra ner lite mer och försöka förstå vad det här är för vilka egenskaper det finns med de här katastrofbonds. Så du gillar ju mycket försäkringsbolag.
Absolut.
Men historiskt så det tangerar mycket av det. Men jag tycker vi kör igång.
Det gör vi. Ralph, very nice to have you here.
Well, thank you for having me.
So you're an expert on cat bonds. For how long have you been at GAM?
Well, I've been with GAM for now something like 22 years, a bit more actually. And, basically working mainly as an investment specialist. In other firms, they would call this product specialist. So basically covering all fixed income products that we manage, both, vis-a-vis, the investment teams and relative to our, distribution people and clients. And prior to that, I was with UBS, mainly in investment banking, but also very much in fixed income and in credit. And overall, I've been with UBS for about 15 years. So it's a relatively short CV, but pretty much throughout my CV, fixed income and credit certainly dominate, as well as structured finance. And certainly, cat bonds that we talk about today is certainly part of that universe.
How come you got interested in cat bonds originally?
Well, when I joined GAM, GAM was pretty much one of the first investment houses in Europe that, marketed cat bonds, with probably the leading firm, that is managing cat bonds globally. And, per default, I had to get interested in cat bonds. And the more I learned about it, the more excited I got about it. So, but certainly, it goes back, I would say, probably more than 20 years I've been involved in some shape or another in cat bonds. On a day-to-day basis.
So what are cat bonds and how do they work?
Well, I would say in a nutshell, and maybe this sounds a bit academic, but cat bonds are bonds that are linked to the occurrence, intensity, and scope of insured natural events, mainly. And this can be windstorms like hurricanes or typhoons, earthquakes, or wildfires, flooding, this sort of events. That's a relatively narrow definition of it. So, the bond basically, pays out if a natural disaster as defined is happening, and if it reaches the predefined minimum intensity, and if it meets, the defined parameters in terms of, scope and width of this natural disaster event. That's, really quite different to corporate bonds, because ultimately corporate bonds are linked, the ultimate payout is linked to the ability and willingness of the issuer to pay. So it's really quite different to what we see, let's say, in the traditional bond space. Now, to the second part of your question, how do they work? Well, essentially, you have a so-called sponsor, and the sponsor typically, in most cases, or in many cases, will be an insurance company or a reinsurance company that is looking, to transfer, part of its insurance exposure to capital market investors. The way this is done is that the sponsor sets up an issuance vehicle, a so-called special insurance vehicle, that will then ultimately issue the bonds. Now, between the sponsor, i.e. the insurance company or the reinsurance company, and the issuer, there is a reinsurance contract to transfer the risk, the insurance risks, as defined, from the balance sheet of the insurance company or reinsurance company to the issuer. Now, the issuer, let's assume this is 100 million of risk that is being transferred. This is then being capitalized by issuing bonds to investors, i.e. cat bonds. So you raise 100 million, and this 100 million, the issuer puts into a collateral pool. Because, insurance risk is not, something that materializes immediately as of issuance, but may materialize over the life of the cat bond. So you put it aside into a collateral pool that sits there in the case that, the disaster event is happening. And then, this needs to be covered either in full or partially, depending what the contractual agreements are. So you have the sponsor on one side, basically setting up the issuer vehicle. And it's important to say that the issuer vehicle is legally and financially completely independent of the sponsor. So if something happens to the insurance company, that has no direct impact on the bond issuer of the cat bond. So that's the initial setup. And then if you think about it over time, if nothing happens over if the insured event that has been, the risk of which has been transferred, has not happened, then basically at maturity, the cat bond is being, pays back to investors. So investors get, on the one hand side, the capital back. They get, the insurance premium that is basically, the compensation you receive under the reinsurance contract. They get that, which obviously pays out regularly over the life of the bond. And you get the return from the collateral pool. Or in other words, if we look at the current environment, on average, cat bonds have a risk premium of a bit more than 900 basis points a year. And the underlying collateral pool, which typically invests in US Treasury bills, very short dated, so very low risk as well, and duration risk as well, which currently pays something like 4.75%. So per year, if nothing happens, you would get 9% insurance premium plus the collateral return. That would give you something like close to 14% a year, each year until maturity. Now, if a major event happens, let's say this bond or the reinsurance contract is basically bundling insurance risk from hurricane risk in Florida. Now, if a major hurricane happens, and important to note, not every hurricane means there is a payout. But, if there is a major hurricane that meets all the trigger levels that need to be met for it to be an insured event, then, the bond pays out either partially or, if it's a very bad event, in full. So 100 or less are then being transferred to the sponsor, i.e. the insurance company, to cover, the losses under the insurance policy. Now, on average, the capital losses per year in the cat bond market are a bit less than 1% a year. Now, maybe I've already gone a bit too far here, but hopefully that gives a bit of an idea how these bonds work and how they are different to, let's say, traditional corporate bonds that most people come across most of the time.
How do they differ? I mean, the performance, it sounds quite high performance. If you compare it to ordinary fixed incomes?
Yeah, let's take the last 3 years. The last 3 years for traditional fixed income investors have been, pretty hard, to say the least. And over the last 3 years, cat bonds have made, close to 11% a year over the last 3 years. High yield made about 4.5% a year over the last 3 years. And the investment grade made 0.2% a year over the last 3 years. And, why is this, different? Obviously, cat bonds have a very different and much lower duration risk, i.e. interest rate sensitivity. And actually, the rise in yields was actually good for cat bonds because it meant, the return you generate from the very short dated paper in the collateral pool got much higher than previously. Previously they were close to zero because central banks were following pretty much zero rate policies. So that got up, from 0 to about 5%. And at the same time, also credit spreads widened. And why did they widen? Mainly because of supply and demand, because more and more insurance companies and also other issuers, even in the corporate space, are using cat bonds. And, cat bonds in terms of traditional, let's say strategic investors, is a relatively narrow asset class still, if you compare it to other fixed income asset classes. And that basically meant, this, let's say, very high demand by insurance companies and other issuers to issue cat bonds. You need to meet that with investors who put money in. And, to attract those investors, you have to pay up with your spread. So rather than, the 400 or 600 basis points the cat bonds had, in the past, now we are talking, about 900 basis points. And that obviously is reflected in performance. That's really just the absolute return or performance angle of cat bonds. What's also, certainly important is these returns, almost 11% a year over the last 3 years. They were truly uncorrelated. And that's not just true for the last 3 years, but that's true since cat bonds have been around. Why? Because what's driving the payout profile of cat bonds is very different to what's driving corporate bonds or other asset classes. If we look at what's been driving corporate bonds over the last years, and not just 3 years, but longer than that, it has mainly been, central bank behavior, both in terms of interest rate policy and policy expectations and in terms of quant easing and so on. While cat bonds have been driven mainly, is a natural disaster as defined happening, yes or no? And that's very different. The hurricane will hit Florida, as an example, irrespective of what Mr. Powell or Madame Lagarde are doing. And that means you have, with cat bonds, a near zero correlation to pretty much most other major asset classes out there, not just fixed income, but also equities, commodities, and so on. What's also different with cat bonds is when you compare their payoff profile and their performance behavior over time, they have much lower drawdowns than corporate bonds with similar rating and duration profiles. And they have shorter recovery periods. So if you have a drawdown, you recover much faster than with corporate bonds, which ultimately means that you're generating about 3 times higher risk-adjusted returns with cat bonds. If we take, Sharpe ratio as a measure, it's about 3 times higher than for corporate bonds. So there are various angles to performance of cat bonds, absolute, relative, correlation-wise, in terms of drawdowns and recovery periods. But from each of these angles, you can, soberly come to the conclusion that cat bond offers you a much better deal, ultimately, than other fixed income asset classes or many other, major asset classes out there. That was maybe a very long answer to a very short question.
So it sounds like it's the cat bonds are very good for diversification in a large portfolio.
Absolutely.
The big institutions, how much do they allocate to cat bonds?
The overall market is close to $50 billion US dollars. Most of that is held by institutional investors. That's pension funds to a very large extent, endowments of universities. That's actually also other insurance and reinsurance companies. And it's also, quite, increasingly, visible in, private banking portfolios with high net worth individuals looking to optimize returns and improve diversification within their portfolios. But certainly, the dominant force is institutional investors. And you cannot necessarily say, that's the typical profile of an institutional investor. You would, when we look at it, and we are probably representative because we are, probably one of the largest investors if not the largest investor in cat bonds. And when I look at our funds, a typical institutional allocation will typically be something like 30 to 50 million US dollar equivalent. But obviously, the size, we also have much bigger size allocations, but that's also because these institutional investors in terms of assets are also much larger. But typically you're looking at 30, 50 million for an average institutional investor in cat bonds.
We have a lot of discussion about climate changes. We see
Yep.
flooding in Europe, we have never seen that before. Is that changing the cat bond market? Do you get more flooding insurance and that type of... or is it growing in Europe as well, or is it mainly US business, the cat bond market?
Yeah, I mean, I think the answer is yes and no. So on the one hand side, it is certainly changing in a sense that, there are certain insurance risks where, insurance companies or reinsurance companies today are just not providing insurance anymore because of climate change. That also means that, the risks that are being transferred within the cat bond markets have become different. Also, the structuring of risk, i.e., at which level are you starting to be hit as a cat bond investor if a major event happens? These triggers or thresholds, better, have moved upwards. So you get more buffer today because, insurance companies are per definition relatively cautious people or cautious entities. And that means that we are seeing adjustments there. At the same time, certainly, the demand for cat bonds, to issue cat bonds for risk diversification within the insurance companies, but also for capital management and for insurance business capacity management, that has increased, and therefore cat bonds play a pretty important role in providing the insurance markets with an additional layer of capacity and ability to diversify and optimize risk and also capital allocation within the insurance industry. So yes, I mean, there are changes, clearly. But then again, I think when we look at climate change, and I'm the last one to deny that climate change is not happening, unlike some other politicians, it is happening. And certainly, insured losses in nominal terms will rise. But when we look at insured losses, we have to take two things into account. Let's take the example of a hurricane in Florida today and maybe 20 years ago. Let's take, this hurricane. It goes through Florida and causes 50 billion of insurance losses. Now, if you go 20 years back, the exactly same hurricane would probably have caused only losses of 20 million. Why? Because on the one hand side, the assets that are being insured, i.e., mainly houses that are being insured, over these 20 years have risen in value a lot. Even if you just look over the last 15 years or so, house prices in the US have more than doubled. So per definition, the nominal losses are getting bigger because the underlying values that are being insured are also going up in nominal terms in their value. The other big element is that, of density. 20 years ago, the exactly same hurricane goes through Florida. It may destroy maybe, 2,000 houses. Now, the exactly same hurricane today would probably destroy 3,000 houses because, population growth and density has increased. So per definition, nominal losses are increasing, and climate change is an additional catalyst to that. But the insurance industry, is accommodating for the effects of climate change via higher thresholds, certain things they don't insure anymore, higher insurance premia, And at the same time, when we read in the press that, Hurricane XYZ, or for instance, has caused record high losses, everybody is alarmed and it will be on the TV the next day. But if you adjust the losses for inflation, asset price inflation, as I've mentioned before, with this example over 20 years, and density, then actually the losses are relatively stable. So, in that sense, I think, yes, climate change is changing the market on the one hand side, but in terms of actual inflation adjusted and density adjusted losses, it's pretty, not really much has changed. But certainly the good thing is, that insurance companies, they have become even more conservative, more cautious. That means the insurance terms in the underlying insurance contracts are getting more and more cautious. And, these more and more cautious contracts are then bundled and are basically then the backdrop to the reinsurance agreement that is basically relevant for the cat bond between the sponsor and the cat bond issuance vehicle. So hopefully I've not been too esoteric here. I hope this makes a bit of sense. Again, a very long answer to a short question,
Yes.
but I hope this gives a bit of additional, insight into why, what are the effects of climate change? Because, that's one of the most prominent questions we get. So I'm not surprised you're asking it as well.
But one question from me. How do you decide which cat bonds to include in your portfolio?
Well, it's basically two angles. On the one hand side, we look at it qualitatively. We spend on each cat bond, even if we don't invest in it ultimately, we spend more than 100 hours per individual cat bond issuance on qualitative research, i.e. legal documentation, etc., stress testing, and so on. And then we use a lot of quantitative models in-house that are our own proprietary models. And the approach we use is very different to what most other people are doing. Most people are basically valuing cat bonds based on expected loss. We value cat bonds on the basis of the so-called exceedance curve, i.e. we look at what is the loss potential over the life of the cat bond in a 100-year event. So we are really more focused not on the average expected loss, but on the fat tail expected loss. And given that we do this for each and every cat bond, this also gives us a market curve, based on risk versus return. And on that basis, obviously, the bonds that sit above the curve, these are the bonds that we are mainly interested in. But at the same time, and although we mainly concentrate on US natural disaster risk, we are basically looking to have a reasonable diversification within our allocation. So that means that we have, most of the risks in the cat bond market reflected, but probably our weightings towards these risks, given our modeling approach, are probably quite different. So ultimately, it really starts with each individual cat bonds, even if we don't buy it, and then looking at it within the market context, and then that gives us the buy or sell signals, and that drives to a large extent our portfolio allocations.
Great. Now we have just a few seconds left. Where is it possible to buy the fund?
Well, it's not just a great asset class. You can also access it. For instance, with GAM, our fund, we provide Swedish krona hedge share classes, both to institutional and private investors. So, it's an asset class that is relatively easily accessible. So not just a great story, but it's also easily accessible. Thank you.
Perfect.